Let's move a little bit. We have about 5 minutes left before I start taking your questions, so please continue sending them in. Doug, I wanted to ask about, when it comes to evolving policies, the subject of much of our discussion last year, and that's around immigration. Since we talked about it, massive changes on the temporary side, but also on the permanent side. A few months ago, the minister announced a 20% cut to the permanent targets moving forward. We talked about it in an affordability context last year. What do you think the impact of those policy changes over the long term will be on growth?
Not that big. So I think we should be very clear here what we're looking at on the immigration front in the next year. If they hit their targets, and that's a huge if, we'd be looking at roughly zero population growth over the next couple of years. But I would see that just as a counter to the excesses of the past couple of years. If you average it out over 4 years, we're still looking at population growth of about 1.5% per year, which is above our long-run average. And over the short term, I'm just not in the camp that believes this is going to lead to a big contraction in the economy. There's zero correlation between population growth and economic growth over the short term. Over the longer term, yes, obviously the size of your labor force is a key building block of your economic growth. But over the short term, I think it's not that big of a driver. And I believe that whoever is in power within a couple of years, we're going to be back to relatively healthy inflows of immigration, probably on the line of 1 to 1.5% for our population. So I don't see this as a long-term structural issue. I think structural change. I think it's really just a response to the excesses of the past couple of years. If I may, I'd just like to say something. We've heard a lot of negativity on the economy. A stinker, for instance. I would just point out that Canada is one of the most interest-sensitive economies in the world. We have very high levels of household debt. It turns over relatively quickly. We have just had the most aggressive interest rate cuts in the world in the last year. I would say, were it not for the tariff risk, we would actually be looking at a relatively optimistic outcome for the Canadian economy over the next couple of years, as that huge burden of the high interest rates gets lifted off of the Canadian consumer. The reason why we have underperformed the U.S. to such a degree is because of that interest sensitivity, which is now we're on the other side of it and going in the opposite way. So I realize this is a bit like saying, how was the play, Mrs. Lincoln, on the outside of the tariffs, but I actually do think the outlook for the economy was relatively bright at this point.
And it is also worth noting that productivity is correlated with the speed of the economy. When the economy is sluggish, and I would agree with Doug, the sluggishness of the past couple of years has been deliberate. It was to raise interest rates to slow the Canadian economy. When the economy is sluggish, the waiter is serving half as many tables because the restaurant isn't full. The other businesses are not operating at full tilt, and you tend to get weaker output per hour. So actually, part of improving productivity is just cutting interest rates, getting businesses to do more capital spending with lower interest rates, getting those restaurants and so on more full. You get more output per hour from both of those things. So we will have a recovery there. And that's why when you look at Europe, for example, they also slowed their economy. They've also had that productivity growth, and we would expect to see some improvement there. So, it is true that we've been on a doom and gloom thing. We don't want to spoil your whole breakfast. But the reality is that if we don't get tariffs, I think all of our forecasts were that prior to that risk, that the Canadian economy was going to do better. And we don't need all those foreign workers. We've got 6.8% unemployment. So we've got a lot of Canadians who are looking for jobs.
I actually did, Francis, want to ask you about the trajectory for interest rates, and I acknowledge, obviously, with the threat of tariffs, that's a complicated prediction to make right now. But this time last year, again, we were all on the edge of our seats wondering how many cuts, when the cuts would start, all that kind of stuff. We obviously did see a successive number of them throughout the year. Where do you see the bank going this year?
Well, the bank isn't done. That's pretty clear. We know that we'll probably be getting more rate cuts, but they've intimated that they maybe not be as large as what we've seen, or they may have a different frequency. So we at RBC, we see 5 more 25 basis point cuts. I think that's probably one of the more aggressive calls, seeing the Bank of Canada ending at 2%. Could it be 2.25%? Sure. Based on the information that we have now, our view is that there's a little more easing that has to happen to relieve some of this burden that exists. And I think what my colleagues are highlighting is really important for the general Canadian public to recognize, which is there's a very big difference between the cyclical factors that are driving Canada on a year-to-year basis and the structural ones. And that's why I use the example of the immune system. The immune system is what is your general state of being on a permanent basis, and we all agree up here that it's pretty weak. And then you have these shocks that come into the system, and it's your ability to be resilient or not. We had this very sizable interest rate shock, think of that, of the bad cold, and we're really getting over that. This is such a really critical point that I think just about everyone here had a re-acceleration or is feeling better about the second half of 2025 because of those rate cuts. Now this is where forecasting gets a bit tricky. My forecast would change if I reduce the amount of rate cuts that are involved, because I'd say, well, actually, that's not going to be as supportive of growth as we would think. So there's an interplay between it. For most Canadians, I think the story is that there will be more rate cuts. It will not go down forever. We are not going back to 0% unless we get a sizable big new shock, something like tariffs, but a reasonable base case. And there are always changes to that. A reasonable base case, from our point of view, is that we get closer to 2, maybe a little bit above 2, depending on some of the evolving factors with inflation.
Okay, we've got audience questions now. Please do keep texting them in. And now you get to see what they are. They're right there. Beata, I'll start with you. If you were providing advice to the next Prime Minister of Canada relating to economic policy, what would your top 3 pieces of advice be?
Start over on the tax system. Our tax system is atrocious. It's overly burdened, it's overly layered. We pick and choose industries on corporate taxes and subsidies and credits, and our income tax rates are extremely high and discouraging of high net worth and entrepreneurs. I think the best thing that came out of the Perot government is, I think, the increase in the inclusion rate of the capital gains tax got shelved, and hopefully...
CRA says it's still good.
Yeah, if there's an election, it's a done deal. And that is one huge complaint I've been hearing when I talk to clients, especially those who are entrepreneurs or looking to do startups where most of your income is coming off of capital gains through the growth of companies, and we obviously have this big problem already in Canada. So going back to your point of how many times have we done assessments of interprovincial rules, well, the income tax and the corporate tax is another one of these, right? It's a 10-year study, and I think they need to say, let's do a review over the next 6 to 12 months and let's get ourselves in a competitive state. Because, going back to the structure of the economy, we are a very small country in the grand scheme of the world, and we live next to a behemoth. And so, as much as we don't want to compare ourselves to the US and to the unique advantages they have, that is our biggest trading partner. And it's not sufficient to have a tax structure that is equivalent to their tax structure. You have to get more competitive and create a compelling reason of why you would choose Canada, in light of the fact that you might have political risks to deal with the US that can block trade at any moment. You have to create a compelling reason on why Canada is greater. And it can't just be based on your immigration and population policy, because that's really easy to turn the dial in the US, and they're having those conversations with Elon Musk and others, right? So we have to, I think, really have some big thought and thinks on that front. And then I would go after where we've overly layered regulation. I think Stéphane likes to argue with me, but we actually weren't arguing, we agree on the same point. On my point on Norway, the reason they got EVs as high as they did was because of large subsidies, to show you there's a number of ways you can get a policy outcome. One, by putting a gun to the head of the industry, another by incenting people in a positive way. And yes, it costs you money. Personally, I think many people would rather get the money to put towards EVs than to a Christmas tree. This is just my thought, right? $1 billion towards, that HST, $6 billion in money, 200, which got canceled.
I don't think those checks are coming out anywhere.
Yeah, but I'm saying that was an idea that was combined $6 billion, and there was much better use for that money. And it is something that would be much more productive and positive for the country. And I think we have to start thinking of the value add of every tax dollar going into this economy, as opposed to just free money to spend or vote getting money. So I would start with the tax structure and the regulatory structure.
Anyone else want to answer that question, Stéphane?
Can I take the capital gains one?
Go for it. Yeah, someone else had asked about what I think.
Can you ask it? It's got to come back. But
yeah, it's
okay.
Capital gains changes, and it will come into effect.
Okay, so I'm going to do a little bit of advertisement on this one. The CDL, I really like the CDL. They put out a great paper this morning, signed by Jack Mintz, Do you know the industries that are being hit the hardest by the capital gains inclusion rate? We need to build homes, construction. We have a shaggy manufacturing sector, manufacturing gets hurt again. So all the sectors that we need to drive our growth in the next 6 months are being hit by that capital gains inclusion rate. We need to scrap it now. We don't have to wait for you, Prime Minister, to say that it was a mistake to have this in the last budget. We were assuming that another party would be elected in the US. Not the case anymore. I'm changing my mind. That has to be done. You want to build a data center in Canada right now? We're 50% cheaper in the US than natural gas. But with the carbon tax, we're more expensive. We have a carbon tax in Canada, but our big trading partner doesn't have one. I want to reduce CO2 emissions now, but I'm not going to send those data centers to Malaysia and Singapore. Why would they not be in Canada? But economically, they don't make sense because of the carbon tax. So how do you go about rebuilding your economy if you can't even react to global events and change your mind?
Make a point. The Canadian dollar has been weakening, but actually that's not really been the story since the lead up to the election of Donald Trump. What's actually happening is the US dollar is strengthening against all the major trading partners. And in fact, our currency has actually not been the worst. And what that's really telling you is that if you do get into a two-way trade war, much to Donald Trump's chagrin, actually, one of the consequences will be that the US dollar gets pushed higher, and that therefore the ability of the US to actually run a smaller trade deficit gets rapidly diminished. In the end, basically the exchange rate does some of the moving. Now, that's not a happy consequence. You know, if I told you the Canadian dollar is going to be 150 or 155, it's always going to depend on a number of factors, but it's certainly going to be substantially weaker. That does help cushion our exports, but let's not forget, it makes us poorer, right? When we want to import things, we can afford less. So this is an adjustment. It's part of the adjustment that we would see is a weaker exchange rate to help cushion the blow on our exports. And we would likely have maybe more interest rate cuts than Francis was talking about to help stir up domestic demand to replace those exports. But all of those things, you know, to some extent, there's negatives for all of them. But a weaker Canadian dollar would be pretty much a given. So what you've seen really is the market pricing in some odds that this is happening. That's why the dollar has moved. But I don't know what odds. I think actually it's interesting when you poll US investors on various issues, they tend to believe, maybe it's wishful thinking, that all the things they liked about Donald Trump's electoral platform are going to happen. So lower corporate tax rates, lighter regulation, more oil drilling, all that's going to happen. If you ask Americans, what about big tariffs and all the disruptions that would cause, they tend to say, oh, well, that's not going to happen. So we certainly have not fully priced in the impact of a 10 or 20 or certainly 25% tariff. So pick 150 something Canadian dollars to the US dollar, something like that, entirely plausible in a high tariff scenario where the Bank of Canada has to cut rates more and where our trade flows initially slow, so we have fewer people buying Canadian dollars to buy our cars and so on. All of that is just a weaker Canadian dollar. And the good news is you'll still be able to get a good deal on a vacation in Mexico.
I think actually this is an extraordinarily important question, and it goes to something that we've been talking today about the trade theory that we all grew up on and how we think about tariffs. This is not how the new U.S. administration thinks about tariffs. And President Trump, or President-elect Trump, is the new lead of his economic advisory, who's written plenty of papers, might be why he's in his position now, that says, well, in 2018, we didn't see inflation in the United States on imports that were tariffed because the U.S. dollar strengthened very much. So there's an embedded theory that is going through Washington that as long as there's a strong U.S. dollar, we get all of the benefits in America of the tariffs and reduced of the negative impacts that come through. That might not be what this group would necessarily agree on, but that is the rationale. And if you go back and listen to President Trump in Chicago, he talked about how much he loved tariffs, and he received pushback from the Bloomberg editor-in-chief, I think, well, that's not how tariffs work. And he said, well, I reject and reject the way that tariffs have been described. So sometimes I go see clients in the US and they'll say, well, tariffs have impacts in 3 ways. First, we see inventory hoarding. So you know the price is gonna go up on something, you bring in tons of inventories, boosts growth. Then you see the price increase, then you see the demand shock, so growth declines. And they'll say, no, 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 because there's a 4th step, which is that manufacturing comes home to America. We haven't seen evidence of that. But when we talk a lot about these tariffs and their impact, I think a lot of conversations focus on what's the immediacy, what happens in 2025. But it seems to me that the American economic theory around them is more long-term. It's focused on, we know there are consequences in the short term, but they can be mitigated by things like FX. They can be mitigated if we focus on the long haul. So the US dollar question and its implications for other things, I think will be a really important theme for 2025.
Doug, we've got a question here. What role do you think gold or crypto might play in the future, considering the focus on both assets by key players in the new U.S. administration?
Do I seriously have to answer the crypto question?
You're getting all the good questions.
Yeah, I know.
We're done.
By the way, I just want to say my blue tie has no political connotations. I happen to work for BMO, of course. Yes, so crypto was one of the big winners in the wake of the election, as was the U.S. dollar, by the way. It's interesting that crypto's taken a big step back, though, as U.S. bond yields have risen in the past few weeks. You know, there are some downsides to what Mr. Trump has suggested for the economy, and one concern is, look, Avery touched on it, he's coming into it with a $2 trillion budget deficit. There really is not much room to work on that side. And I think investors occasionally are showing some flashes of concern about the size of that budget deficit. We're seeing the 10-year Treasury yield in the U.S. forging back up towards 5% at this point. That's bad news for all risk assets, including crypto, by the way. And meanwhile, we're also seeing a real sell-off in UK gilts as well, UK bonds at this point. So I think that could be one limiter for the Trump agenda, is the bond market that could rebel. It's very interesting that even as the Fed has cut by 100 basis points in the last few months, we've actually seen long-term U.S. bond yields rise to almost the highest of the cycle. Last point I'll make, by the way, again, we've been so gloomy on Canada. It's a very different story in Canada. We're actually looking at record spreads versus the U.S. at this point in the bond market. So in other words, the government of Canada can borrow your money for 10 years for 3.3% versus almost a 5% 10-year Treasury yield at this point. That is a ginormous spread. I mean, for decades, the shoe used to be on the other foot. In other words, Canada had to pay more than a percentage point above and beyond what the U.S. paid for long-term money, and it's completely flipped, which I suppose longer term could be considered good news from a Canadian perspective.
So lately, Stéphane, the incoming president, hasn't just been talking about tariffs, he's been talking about annexing Canada. He called the border the other day artificial, said that he would use economic force. Our next question is in relation to that. Would an arrangement where borders are erased, like in Europe, be beneficial for Canada? Why would we not enter one of that type of arrangement with the U.S.?
I just told you before, we have a 24% tariff equivalent between the provinces.
21, you said.
21, yeah. So how do you enter a Schengen? You're pretty good. You're exceptional. Is that what you said? Carol said, called you exceptional. No, so that wouldn't work from a game perspective. I mean, no. The setup is completely different. Structurally, that doesn't work. What Doug said before, I mean, this is the first bear steepener for financial markets in fixed income market in over 30 years. There's a lot of people in the industry have never seen a bear steepener. I think that will discipline the president so we don't have to even think about the Schengen area with the Americans. Do you have kids?
Yes.
Yeah, how long do you want to keep them at home?
Forever.
Okay, well not even...
I'm sure we have a sick arrangement with that kind of stuff.
You know what the median age is for first-time home buyers in the U.S. right now? 38. You want to keep your kids as long as that?
I mean, I do, but I understand your point.
So Donald Trump was elected to cater to his base, which is the middle class. You want to keep your kids at home for that long. That number is up 6 years from pre-COVID levels. So what Doug is saying about long-term rates moving higher, that means even though the Fed is cutting rate, the 30-year mortgage rate is rising in the U.S. that will upset many people in the US. So, and if it continues to rise, well, by the time Donald Trump comes to office on January 20th, the market will be down 10%. So here's my short-term forecast. The stock market down 10% by the time Donald Trump arrives. I think that will buy us a little bit more time before the tariffs are impacting the rest of the world.
Yes. Stéphane's point makes me, Avery, think of one thing that we haven't addressed yet. We've kind of talked a little bit around it, housing and affordability, which again at this time last year was, I mean, it continues to be a massive issue, but it was at the forefront of public discourse. There's some questions from the audience, more questions about interest rate cuts. I wondered what your assessment of housing and housing affordability, or even just access to the market right now is.
So mortgage rates have come down, and I think they will come down further. The problem is that with a given supply of housing, you create more potential buyers. You don't really improve affordability because prices start drifting up again. So I think all political parties have finally sort of gotten onto the idea that giving a check to a first-time home buyer and doing anything that gives money in people's pockets just bids up the price of housing. That it's really all about incenting supply. And the good news is that we will, in the next federal election, have two political parties, the Liberals and the Conservatives, two major parties at least, both focused on things related to supply. So that's a good thing. What I would say is that we also have to work on some of the other details here, because we've got development charges, we have building codes and very intricate building codes. You know, one of the worst productivity sectors, by the way, in Canada is construction. Output per hour in construction has been steadily going down. And part of that may be the regulatory burden and so on that slows activity. So we need to do all of those things, and we're slowing population growth. So actually, I think we do have a fighting chance of making affordability a little bit better in the sense that prices don't suddenly rebound, even though interest rates have come down, because we do make a bigger effort on supply. One problem we face is that part of our supply is condos. And anyone who knows what's happened in the condo market in Toronto in the last year knows that they're not selling like hotcakes these days, let's just put it that way. So we've got all those signs around the city everywhere, condo coming, but there's no one actually walking into the showrooms. And because we sell them before we build them, it means that at least next year we won't be building many. So it's probably a 2026 story before we really see that multiple unit construction pick up. We do need to send more apartment buildings because people want rentals. They don't want all these tiny little units. We need to create rental space that a family could live in. We haven't been doing that. So there's still a shortage in 3-bedroom units, for example. There's all these 1-bedrooms and studios and so on. So I think there's still policy work to be done. But actually, for the first time in a while, I'm encouraged that we have, I think now, the makings of both the political will to create more supply, add density, and we have lower interest rates, which are going to help buyers, and maybe and slower population growth. We have the recipe here where affordability might well improve a bit. And by the way, the US has seen a similar erosion in affordability. It's not just in Canada. One reason voters didn't like the Democrats, even though inflation in the US wasn't that high, is because the way the US measures inflation, they don't measure the cost of buying a house and what the mortgage is and so on. They leave that out. And if you put it in the way we do, their inflation would have actually looked quite a bit higher. So Americans were angry about high 30-year mortgage rates and the inability of their kids to move out, and they didn't want the 38-year-olds still living at home. And so, they too have a similar issue. It is not just a Canadian story. It is, in fact, many countries have seen the same sort of thing.
So, Beata, we just have a few minutes left, but for my son who leaves home at 55 years old, for I guess people who are leaving at 25, like, is there the prospect on the horizon of a 25-year-old being able to afford a home? Because I think that's the crux of when people talk about my pocketbook, my affordability, like, yes, food prices are super high, but also it's just the fact that no one I know who's in the 5 to 10 year age range younger than me can buy a house.
Got to go to Gaspé, New Brunswick. They can pick one up. So yeah, not in Toronto, and
even outside of Toronto, other markets as well.
And yes, but other provinces are not as pricey as we are in Ontario and BC. The issue on home ownership has never been an issue for those who are children of parents who are homeowners. The data shows that they will also be homeowners, not through the inheritance of their parents' home itself, but through the wealth transfer mechanism. And so we have a report on this if you're interested. But there's very strong data that we should not be overly fussed with those who have parents who are homeowners. They're likely going to be fine. They also learn through their parents about financing, mortgages, and so the financial literacy level is better in that situation. Those who are unlikely to be homeowners are the ones who don't already have parents who are homeowners. They don't build up wealth as quickly as homeowners. Think about your house, how much it's appreciated, and the store of value that is, in addition to equity. If you only have one channel, and that channel happens to be more volatile, you don't do as well, or haven't done as well historically. And so one of our policy recommendations is when we're thinking about where to put that tax dollar, and to have the most tax efficiency support that you can possibly get, if your goal is on home ownership, then it needs to be on those who don't have parents who are homeowners and don't have that store of value of wealth in the household. And that's affordability of home ownership. If it's affordability, meaning rental needs to be affordable, well, rental rates are declining, and that's now well documented. And so that side of the market is absolutely becoming more affordable, including in Toronto, in part because of what Avery's already talking about, which is this overabundance of supply and investors now having to discount rent rates. So the economics for investment have gone down, but it has certainly improved for those who are on the rental side of the market. So it really depends on the nuances of where you want to go. But if you want to keep your kid at home until they're 55, you're in the right market, you're good.
Sweet. Okay, on that note, I have to end it there, that we're out of time. I want to thank all of you for your time. Stéphane Marion, Francis Donald, Doug Porter, Beata Caranci, and Avery Shenfeld. Thank you all for your time as well. It's been a pleasure to share the stage